right. A very warm welcome and good afternoon to all the people and good morning to all the ones attending the program from Netherlands. Friends, on behalf of ICAI Netherlands chapter, I welcome you all on fourth day of refresher course on international tax. Friends, as you know, this is a very important subject. The entire course captures the key elements of bilateral tax treaties. In last three sessions, you have gathered a broad understanding of what tax treaties do to tax residents, why they are made, what is their benefit, what is their object. We have gone into details on Article 1 to Article 2, Article 3, Article 4, Article 5, 7. And today, friends, we are going to deal with Article 11, 12, 10, 11, 12, and 13. Now, friends, as you know, these are the most important distributor articles because the maximum income that flows between for a company can come in the form of dividends, it can come in the form of interest, or it can capital gains. So if you look at Article 10, Article 11, Article 12, and Article 13, friends, this is comprised of most important income for any multinational. So today, we broadly capture these work for these four articles, meaning for four different type of incomes. So it's very important, friends, because on a day-to-day basis, in a for a very practical matter, these are the four most applied articles in any company. And to address this today, friends, we have Amit Agarwal from Waterhouse. He's a managing director and an expert on international taxation. Amit has been advising a lot of multinationals from India, which are doing business companies.
Yeah, I think Vikas, we are losing you in between.
Yes, no, I lost for a second, so I'm back. So I'm saying that Amit is basically an expert on advising companies on international tax, and these four very important. So I welcome Amit, and thank you so much, Amit, for joining us and agree to address the participants of ICAI Netherlands chapter on behalf of the entire managing committee and the working committee of ICAI Netherlands chapter. I'm thankful to you for this session. Over to you. He is the treasurer of ICAI Netherlands chapter. So once Amit presents his views on these four articles, Govind Bhai is going to moderate the session on Q&A. So once the speaker finishes his session, a Q&A would be taken. So I request all the people who have questions to put their questions in the chat box, so then questions can be taken up. And also I request everyone that, to make this discussion an engaging one, as we have done in last three sessions, friend. And I wish you all a very nice afternoon and a very productive session. Over to you, Amit. Thank you.
Yeah, so thanks a lot, Vikas, for welcoming me for taking this session. And good morning, good afternoon to everyone on this call. And welcome to this refresher course on international tax. As Vikas mentioned, I will be taking four articles, Article 10, 11, 12, and 13. And as Vikas mentioned, these are one of the important articles in any treaty and most actively used articles, I would say, in a corporate scenario and as chartered accountants will come across and to deal with. So in this session, I will be supported by Prateek, and he will be he's a member of my team who has worked on this presentation to put together it, and he will also act as a quiz master. So what we have done, that we have also put in some case studies as we move progress in this presentation, and which Prateek will keep asking you, and just to make this session more interactive and more engaging. So with this, let's start the presentation. So Prateek, if you can put it. Good. So Prateek, you can move to the next slide. So the way I structured the presentation, some preliminary context setting slide, and then obviously I'm dealing with Article 10, 11, 13 in one go, because they are generally more or less related to corporate actions, which is whether dividend, interest, and capital gains. And then obviously I will be dealing then royalty in FTS, which is more of a operating articles relating to the business activity. And this is the way we have structured the presentation. And then obviously in the end, we can have Q&A session as well. And as we go forward, if we have any questions, I will keep answering them. If you can put on the chat box. Prateek, please move ahead. So just and while most of you may know this, but just to set the context that when we have to apply the treaty, and there are three broad limbs we have to see simply where this treaty treaty play will come into play. One is the income. So first we have to determine any receipt, any amount, if first it has to qualify to be an income. That is first. Second, that income should be in the nature which is taxable income. And third, based on this, then we have to see whether this income will be taxable as per the domestic law, or we get a favorable answer from a treaty. So then we'll go back to the treaty after reading the domestic law to say that whether we can get a favorable answer, or we can avoid, or in case of an instance of a double taxation, we are able to avoid the double taxation element by applying the treaty. So these are the three limbs. First, there has to be an income, then it should be a taxable income, and then if both these boxes are ticked, then we have to see that, okay, whatever best answer we are getting, reading the domestic law, read with the treaty. So this is the context, how we have to keep in mind in applying it. Just to again an important element to keep in mind, and I'm just, because we are doing a ICAI course, so then the India angle will definitely be important to consider. So the point is that when in what cases there would be a taxability of non-resident in India, and or when income can be said to be taxed in the hands of non-resident in India. And then there are two elements to it. One, if this income is received or deemed to be received in India, or accrue or arise, or deemed to accrue or arise in India. And I think we all understand what is meaning by received. It is directly received in India. Deemed to be received are cases, very limited cases, which is typically a PF or a pension received by an employee outside India, in India, who is situated outside India. So very limited cases. What requires interpretation is when the income can be deemed to be accrue or arise in India. And there could be two instances broadly where the income can be deemed to accrue or arise in India. One is if it is derived from a presence in India. Say, for example, if any foreign entity has a permanent establishment or a business connection in India, then it has a presence in India, and in that cases, the income can be deemed to accrue or arise in India. And there where we have to see that how we can deal with it. The other broad category when the income can be deemed to accrue or arise in India is the source from India. And this is where the instances of Article 10, 11, 12, and 13 will come into play, which is interest, dividend, capital gains, or royalty, or FTS, where these are in the nature of incomes which are source based, or it is arising from the source in India and hence can be taxed in India at applicable rates subject to the treaty. Typically, if you see, these four categories of income can be taxed in India, or a withholding tax will apply in the rate ranging from 5 to 15%. Generally, in most of the treaties, you will find this is the broad range of taxation of these incomes in India. So for the purpose of this presentation, we will be only focusing on those incomes which are arising from the sources in India, which are these four. Go ahead, Pratik. So now first article which we are dealing is the dividend article. So now let's see, this is typically the definition of a dividend. So first, when we are dealing with the dividend article, first we have to see what is the meaning of dividend typically, and what categories of income can be taxed as dividend. So one obviously is the category of shares, where you are holding shares or securities of a resident of a particular state is holding shares or securities of a company of other state, then any income arising from those shares can be treated as a dividend income. Rights participating in profits. So you may have other rights, contractual rights, where a party or a person of a particular state has certain rights, participating rights in the profits of the company, which is contractual in nature. Third category could be debt claims, and this is we have seen in certain cases and in practical examples as well, that sometimes we can have debt instruments where the interest payment is linked to the performance or the profitability of the company, to say that okay, if the company has profits, then only the interest is payable, and if not, then no interest will be payable. So even such categories of instruments can also fall under the category of, or maybe I would say the interest paid on such instruments can also fall under the category of dividend, and hence taxable as dividend, and accordingly the withholding tax will apply as per the applicable rates. So this is broadly the definition which we have to keep in mind. A bit broad definition that way, and covering various aspects other than shares as well. Move ahead, Pratik. No, this is the example, and we it's a live case, and if you, it's quite a practical cases where we have seen that there are instruments like a Netherlands entity has invested in an Indian entity by way of a compulsorily convertible debenture. Now these debentures are having interest which are linked to the profits. So whenever there are profits, then only the interest is payable, and in such cases, such interest will be taxable as dividend, and applicable withholding tax will apply. This is just an example which I was sharing in the earlier slide, where even an interest payment can classify as a dividend. Now, if we see what is typically the language used in DTAA under Article 10, and if I have to read it out, this is a typical language which is used in most of the treaties, and what they say is dividend paid by a company which is a resident of a contracting state, say India, to a resident of a other contracting state, say Netherlands, may be taxed in the other state, which is Netherlands. So that is a general clause which gives taxing right on dividend to both the states. However, such dividend may also be taxed in the contracting state, that is India, of which the company paying the dividend is a resident, and according to the laws of that state. But if the beneficial owner, and this is we have bolded and we'll explain why, but if the beneficial owner of the dividend is a resident of the other contracting state, the tax so charged shall not exceed the rates applicable or specified in the treaty. So there are two conditions which we have to see. One, the dividend clause is saying that it can be taxed by either states. Second, what it is saying is this dividend or that treaty rate treaty will be applicable only when the person who is receiving the dividend is the beneficial owner of that dividend. And as we move forward, Pratik will through case studies will explain you what could be the various instances where it could be otherwise as well. So that is one. There are those certain treaties and very exceptional cases, and we have seen in the example of Greece or other country, Greece especially, where it gives taxing rights on dividend only to Greece and not to India. I mean, these are very exceptional treaties, but generally you will find that most of the treaties will give taxing rights to both. And then as per the domestic law, one has to see that in which country it is taxable. So if you have to give an example of Netherlands, India, Netherlands do not tax dividend income from a foreign source, but India will tax based on the applicable treaty. It will withhold at a 10% rate the dividend income which is payable to Netherlands. So who will be eligible for the treaty? One is the resident of the contracting state. The person who is receiving, he should be a resident of the contracting state. And second, he should be a beneficial owner. These two things we have to always remember. Go ahead, Pratik. Now, let me explain you then, and I think this is where we have to just decipher between what is a beneficial owner or whether there could be other types of owners as well. So if you see that typically there could be two categories of owner. One is the legal or a registered owner, a person on whose name the shares are registered or who is legally holding the shares. In the example of company, it could be the person whose name is entered in the register of members, but he is holding these shares for and on behalf of somebody else. And this is, you may remember, under Indian Companies Act, you have to file a declaration of beneficial interest where a person can hold shares on behalf of somebody else. So then he would be the legal owner, but the beneficial owner would be somebody else. And whenever we apply the treaty, it will be applicable as per the residential status of the beneficial owner. The beneficial owner is somebody who actually have the ultimate economic right or enjoys the income or control that income and at his own discretion. So he's not bound by anything else to pass on this income to somebody else. He can enjoy that income in his own absolute right. So if I have to summarize, typically from DTAA, if one has to see, the beneficial owner is somebody who has a right to enjoy the economic benefits and free to decide the use of assets and proceeds. If there is a difference in if these two conditions are not met, typically one has to find out that who is actually the beneficial owner, and whenever applying treaty, you have to identify that. You can also get some guidance from the OECD model as well, and OECD has actually explained in a different way. A beneficial, it is like a exclusion definition, which says that a beneficial owner excludes the following. A person who acts as an agent or a nominee, a person who simply acts as a conduit of another person. So if, say, for example, and I've seen in cases like, typically in cases of back-to-back interest, I'm drawing an analogy from the interest thing. Say company A has given interest to company B and company B has given interest, the similar loan to the company C. And it is like a back-to-back loan, and the obligation of company C is to give interest to B, and then B has the obligation to pass on to company A. So then company B is actually acting as a conduit in between, where the actual beneficial owner of that interest or dividend will be the company A, and hence whenever we are applying treaty, we have to keep in mind the beneficial owner principle, which is very important to have the right outcome. Go ahead, Pratik. So depending upon, once we have decided that where the person is resident and who is the beneficial owner, then we have to go by the point that how and at what rate the tax will be withheld in case of the payment of dividend. And again, taking the example of Netherlands-India treaty. So now under the domestic law of India, if you see that tax rate on dividend for non-resident is 20%. So India has to withhold a 20% tax rate if it is making a payment to a Netherlands shareholder. That rate of withholding of 20% can get reduced under applicable treaty and typically ranges from 5 to 15%. In certain cases like Mauritius, it could be 5% or 15% in the US. In Netherlands, it is 10% withholding rate. And that is one way to look at it. And then once you apply the treaty, you can have a lower withholding tax rate. The other way, and the other important point we have typically seen and in certain treaties, there are provisions called MFN, most favored nations, in this most favored nation clause, which typically if we see India has with say Netherlands, Sweden, France, and Sweden or Switzerland, and we'll explain in more greater detail what most favored nation means and how it means. But typically, if if a treaty has a most favored nation clause, by applying that clause, we can import the favorable provisions of some other treaty, and maybe possibly a lower withholding tax can be available to us. So Pratik, you can move to the next slide. So here we will just try to understand that how, by applying the most favored nation clause, how we can reduce our rate of withholding, and typically in the case of a dividend case. And I will just try to read this clause for everybody's interest. So if after the signature of the convention, and this is a protocol between India and Netherlands DTA, which says that if after the signature of this convention, under any convention or agreement between India or a third state, which is a member of a OECD, India should limit its taxation at source on dividend, interest, royalty, and fees for technical service or payment for any use of equipment. Actually, this covers the entire four articles which we'll be covering, to a rate lower or a scope uh, more restricted than the rate or scope provided for this in convention on the said terms of income. Then, as for the date on which the relevant Indian convention or agreement enters into force, the same rate or scope as provided for that in convention or agreement or the said item of income shall also apply under the convention. What it means basically is that if India has signed a treaty with Netherlands, and after signing the treaty with Netherlands, India has signed a treaty with, say, a country, Slovakia, say for example, and then in the treaty with Slovakia, the rate of withholding which India agreed with Slovakia is say 5% instead of 10%, which they have agreed in the Treaty of Netherlands. And Slovakia is also a member of the OECD. Then, by applying this MFN clause, when Indian company will pay dividend to Netherlands, then it has a right to withhold tax at 5% instead of 10%, which is applicable under India-Netherlands Treaty. So this is what the benefit a MFN clause can provide. The diagram below this typically what explains here that how you can approach it. First you have to see that whether this MFN clause is applicable in Netherlands. Then you have to see that, okay, whether the Slovakia treaty also has is a country where India has entered into a treaty which is a member country, and it has entered into a treaty after Netherlands. And third, Slovakia has a favorable clause in relation to dividend article, which gives you a lower rate. If those two conditions are fulfilled, then you can import the provisions of the MFN to the Netherlands Treaty and get a benefit around it. I hope this is clear to everyone. Go ahead, Pratik.
Yeah.
Pratik, you can take up a
So hi everyone. Yeah. So just by way of an introduction, hi, I'm an associate director with the PwC M&A tax practice, working with Amit for more than 7 years in PwC now. I'll be the one who will be making this session quite interactive. Apologies, because of my screen presentation, I'll not be able to see your faces, and I think Zoom has uh, disabled my camera also because of the screen presentation. But I would encourage all of you to participate in these case studies, because let's spice things up around this. Okay. So as Amit explained in the previous slide around the MFN clause, and talking about the major conditions, let's just have a case study around whether any dividend paid by a Netherlands entity or paid by an Indian entity to a Netherlands shareholder would be able to take advantage of the India-Slovenia DTAA. Okay. So the facts are that India had entered into a DTAA with Netherlands in 1989, And India had also entered a DTAA with Slovenia in 2005. Okay, and Slovenia became a OECD member in 2010. Now the question before you guys is whether Indian company, while distributing the dividend, would be able to take advantage of the India Slovenia DTAA. Just for the sake of reference, we have also pasted the Article 10 of the India Slovenia DTAA, and I would like you to focus only on this 5% clause. So just the gist of it, that India Slovenia provides a better rate of tax of 5% than the India Netherlands 10%. Yeah. So just a quick answer whether we would be able to get the advantage of the MFN clause while apply through India Slovenia DTAA.
And anybody can raise hands and answer.
Does anybody know? I don't think. Let's wait for one more minute.
Yeah.
Following the options here. Actually, reaction panel. Okay, I think we are really not great
Okay.
in this detail.
Okay.
So
No problem. So I think in future what we can do is either we can have the replies over on the chat box, or maybe I'll ask the relevant questions with Amit only then.
Yeah, so we got one response from Jaya from 2010 onwards.
Yes. So Jaya, you're absolutely correct. So in this case, because Slovenia became an OECD member from 2010 onwards, and the DTAA signed with Slovenia is after the DTAA signed with Netherlands. So all the conditions prescribed in the previous slide gets fulfilled in this case. So taking reference of the India-Slovenia DTAA, any dividend distributed by the Indian entity to a Netherlands shareholder would be eligible for only 5% withholding tax in India, right? And just to apprise you guys, there has been a positive case law in Delhi High Court, Concentrix Services Netherlands, dealing with a similar issue, and we have a favorable judgment around it. The same has been contested by the Supreme Court in the Supreme Court by the revenue authorities. But yes, we do have a positive case law to back this up.
Yeah. Go ahead, Pratik.
Just a curious question: would this be eligible while for any dividend distributed between 2005 to 2010?
No. Answer, Pratik.
We got answer no.
So, okay, yeah, so it will not be applicable for any dividend which is after signing of the arrangement till the time the other territory is signed as an OECD member. Yeah. Moving on. Amit, over to you.
Okay, so on dividend, another important aspect which we want to bring out, and then we'll link it to the treaty, DTAA, is and from the Indian context is that until March 2020, you guys may know that India has a regime where India was levying dividend distribution tax on the dividend distributed by the companies in India. So there was no tax in the hands of the recipient shareholder, whether resident or non-resident. But at the source level, the companies were deducting a DDT, dividend distribution tax, and depositing with the exchequer. This position got changed in March 31st, 2020, post March 2020, now, where India actually went back to the old regime where the dividend distribution tax regime was abolished, and now India also the taxation rights are now again with India or the holding jurisdiction, depending upon the treaty. So now it is tax in the hands of the recipient, and then one has to apply the treaty to get the applicable rate. And as I earlier mentioned, if you go by the domestic law, it is 20%, and then you have to apply the treaty to get a lower withholding tax rate. So this change in law has obviously given some more nuances to the situation, and we'll also explain you in the case studies as we move forward. But
yeah, so just taking the previous slide carry forwarded, let's consider a fact where an ICO is distributing a dividend to a foreign non-resident company. And hypothetically, let's assume that this was a pre-dividend taxation, that is in a DDT era. So ICO, while distributing dividend to the FCO, would have also deposited a dividend distribution tax to the tax authorities at 20.56%. Now, the question before you guys is whether the FCO would be eligible to claim a credit of that this DDT which has been deposited by the ICO.
Any reaction? Any response? Quick
Any
response?
reaction? Any thoughts around it? Because it's going to be a tricky position, because under Indian income tax, the same was exempt in the hands of FCO, and the taxes have also been deposited by the ICO. But while considering the foreign tax credit, would FCO be eligible to claim a credit of it?
Yeah, so for all participants, I will make it more easy. Like if you would like also to unmute yourself and answer, that also fine.
Yes, I would love to hear your voices, guys.
Yeah. Please.
So the point is that in this case, the taxation is by the tax is paid by ICO and not by FCO. And as per the domestic law, this income was exempt in the hands of FCO. But whether still by applying treaty, and this is where the role of treaty has come in to play. Whether by applying the treaty, one can still say that instead, even though the ICO has paid the dividend tax, whether still the FCO can claim a credit on the amount paid by the ICO.
Okay, I think we can move forward.
Yeah. So just one reaction from my side, Pratik, is logically yes, because they have paid at one place, so probably they should get a credit. But I don't know the real fact here.
Okay. So just to answer you, Gagan, so basically the kind of position one can argue in such a case is that DDT is only a mode of collection of taxes on the dividend distributed by the ICO, and that's what the language of the memorandum reads as well. And it is basically a dividend deposited by the company on behalf of the shareholders for the convenience purposes, right? And the other sake of argument is that the taxes on such DDT is 20%, while the treaty provides for a lower rate of taxes, say 10% or 5% or 15%. So there has been recent judicial precedents from Kolkata ITAT or a Delhi ITAT cases where it has been held that the company depositing the DDT should be eligible for a credit of the excess taxes paid on behalf of the shareholders, as the treaty provides for a lower rate of taxes on such dividend distribution. Okay, definitely the such kind of litigation is a bit litigative still, because we have only ITAT level judicial precedents, and needless to mention the other requirements of the treaties like the residency clauses or the documentation and conduit arrangements, everything needs to be fulfilled around that.
So I think in summary, the argument is that when the DDT regime came, the memorandum to the income tax talks about that we are levying the tax in the hands of the company just to ensure, because it was very difficult to collect from all the shareholders and keep a track. So for convenience, we are saying, okay, instead of shareholders, the company will be paying the tax on behalf of everyone. And I think that argument people have now taken before the court of law to say that, okay, this is just a mode of collection of the tax and not a mode of collection of the tax, and still the incidence of tax is in the hands of the shareholders to that extent. And why not this credit should be available for this amount? And as Pratik mentioned, we got some favorable ruling, but still the matter, a lot of favorable rulings, I would say, of late. But still, the matter is still under, I would say, evaluation. Because still not a Supreme Court judgment on this. But it's an important point to keep note of.
Yeah.
Just a quick additional or step-up question on that. In case we are eligible to receive a refund of this excess tax deposited, would the refund be received by the company or the shareholders? Because the tax has been deposited by the company, but credit is being looked from the shareholders' lens, right?
how shareholder will manage this? So probably company, right?
Yes, the answer is company, because the tax has been deposited by the company on behalf of
Yeah.
the shareholder. So in case there's an excess tax deposited also, the same should be received by the company. Again, a caveat that it's an ITAT level ruling, so we still need a major rock solid judicial precedent around it.
Yeah. So in addition, there was a question from Ramya. So I think Ramya, even in this case, obviously one can also go back to the MFN clause and apply that as well. So in case of, say, for example, Netherlands example, we can again borrow the MFN clause from Slovenia and then can do it.
Okay.
Slovenia and can do it. Reduce the rate of tax.
Sure.
Yeah, go
Ramya,
ahead,
is
please.
it answered the question, or do you have any follow-up point here? Yeah, okay, it's answered. Thank you.
Yeah. Okay, thank you. No, so I think typically dividend, I would say, if I have to summarize dividend before I move to interest, is that dividend typically is one of the common clause which is applicable. Two things we have to remember: one, who is the resident, where the person receiving the dividend, where he is resident, and he should be a beneficial owner. Number two. Number three, we have to just watch for the MFN clause, that wherever there is a MFN clause, we have an opportunity to reduce the withholding tax rate. And number four, in cases of past cases, wherever the DDT has been paid, one has the opportunity to claim a refund of the DDT in case we have a favorable treaty position. So these are the four takeaways for the section number 1. Okay, move ahead, Pratik. Now again, on interest, interest is also typically, if you see, is a quite a wide definition, which covers income from debt claims. It also covers right to participate in the debtor's profit. It also covers income from government securities, income from all sort of bonds and debentures, including premium and prices, and except that the penalty charges on late payment is not covered as per the DTA. Now, typically, if you see right to participate in debtor profit is the example which I covered earlier, that if, say, there's an example of a CCD, debentures, or any other instrument which say that, okay, the interest payment is linked to the profits of the debtor, and when the debtor has a profit, then we'll get a interest or maybe a higher interest. This could be one example of right to participate in debtor's profit. And there could be instances of premium, could be some where there is a bullet payment at the end of the debt tenure. So rather than paying interest every year, I take $100 loan, and then I say, okay, at the end of the tenure, say 10 years, I will pay $120. So these could be the instances of typically premium and right to participate in debtor's profit. Move ahead, Pratik. Now again, we have to now see the language, and typically for ease of reference, I have always taken the reference from India-Netherlands Treaty, which is because of ease of reference. But typically, this clause is also in most of the treaties is generally common or almost similar. So again, if you see the first test for this clause as well is that there has to be the person receiving the interest should be a resident of that other state, and that needs to be demonstrated, like in the similar to the dividend case. It also says that the interest can be taxed in both these states, either of these states. So in the India-Netherlands example, this interest can be taxed in Netherlands as well as in India. So both the states have the right to tax. The person receiving the dividend interest should be a beneficial owner. So that is similar to dividend again. In the Netherlands-India example, if you see that India also tax interest, we have a withholding tax of say 10% in the case of Netherlands. And then Netherlands also tax the interest at its corporate applicable corporate tax rate. So both the states generally tax, but whatever tax is suffered by the Netherlands entity, it will get a credit for the taxes paid by the Indian or withheld by the Indian payer. There have been instances, there have been a clause again that interest from government or government authorities or a loan guaranteed or insured by government, typically that is not taxed or it is exempt from tax. So this is typically the third. So in summary, it has to be a resident, beneficial owner, and interest from government is exempted. And in interest clauses, mostly, in most cases, both the countries have the taxing rights. So I think this I have covered. In interest also, you can have a similar approach where you can, and in interest, typically our experience is that the withholding tax in India is ranging under treaty from 10 to 15%. And again, applying the MFN clause, one can reduce this rate of withholding to a lower rate if there is a favorable treaty available. Move ahead, Pratik.
Okay, so so as Amit mentioned in the previous slide, for an interest taxability, the recipient again has a very similar conditions of dividend, which is a residency as well as the beneficial owner. So we thought of just having one small case study on the beneficial owner. Here, what we are saying is that the US is the ultimate holding company, which has given a loan to an intermediate holding company in Netherlands of $100 million. And there is a back-to-back arrangement between that Netherlands holding company of giving loan to the operating company in India. Now, the rate of interest as well as all the terms and conditions between the loan provided by the USCO to the BBCO and between the BBCO and the ICO are exactly identical. So whether in such situations can we say that BBCO is not the beneficial owner of this interest and US company is the ultimate beneficial owner of this interest? Any reaction to this?
So there are two questions. One question is who is the beneficial owner in such cases, and what will be the withholding tax rate India?
Yes, we'll come to the second question, but any reaction to the first question around the beneficial ownership?
Let's
Okay, just to answer this, basically
I think maybe we can wait for a 30 seconds.
Let's wait. I think yeah, we got a response on chat from Sandeep.
And Sandeep, why you are saying so? Oh yeah, I think Ramya also said. But why you are saying US could be the beneficial owner?
Yeah, please unmute yourself.
Yeah, so you are right, Sandeep. So basically, BV is acting as a conduit. So if what Pratik mentioned, if it is like back to back, all the terms and everything is same, all conditions, terms and conditions, everything is same, then somebody can argue to say that BV is acting as a conduit, while the actual beneficial owner is US and will disregard BV as a beneficial owner and the consequences should follow.
Yeah. So once we have established that,
I have a question here.
Yeah.
I'm sorry whether you can hear me.
Yeah,
we can.
No, please continue.
Here, the concept of the beneficial owner, right? Going back to the definition, it talks about right of use of assets and so on and so forth, right?
Mm-hmm.
By virtue of the fact that the loan terms are the same and there's the same term sheets and payment rights and all that. Does that condition by itself, then sort of equate the US company to be a beneficial owner of the loan? I mean, it could happen that the terms and conditions written appear to be similar or same. But isn't there a larger test to be performed where one has to prove that the US company indeed has right of use and right over the assets of the BV?
So you are right, Vijit, and let me answer this question. You are right. So it's not the only test, but it becomes a very important test if you see the OECD definition as well, where it is a exclusion definition that a person should not be acting as a conduit as well. So this is where the problem may arise. But you are right; it will not be like just by saying that it is like back to back and everything is same, but it raises a very significant risk, and you for anybody to justify or counter argue that why US is not acting as a conduit if everything is same. And this is where practically if you see, we have to have some rationales, timing difference in terms of these agreements or terms of the loan to demonstrate that it is not back to back, but maybe it is a bundled loan, and then maybe BV uses to use this loan to lend to 5 entities rather than one, and all those checks and balances needs to be there. Otherwise, somebody will simply say that it is a conduit entity for US, and hence I will disregard the treaty. But you are right in saying that it is not the only test. Obviously, one has to see in a more holistic way, but this definitely impairs or or raise a big concern. Am I?
Thank
Is your question answered?
Yeah. Thank you. Because I was looking at it more from a practical perspective. I mean, because of all the various structuring that is available.
Yeah.
Because companies, they sort of structure it in a way where there is a US company, then there could be something in the Cayman Islands and whatever, who then generally read out these funds through the BV companies in the Netherlands.
Yeah.
And therefore can take advantage of the lower tax rate.
Yes, you are right, but this I have seen a common practice, and we have dealt in the past. But obviously, this needs to be done with a lot of caution, as we mentioned, because then one has to be able to demonstrate on ground that why BV cannot be seen as a conduit. Yeah, go ahead to the next question, Pratik.
Yeah. So hypothetically speaking, it is established that US Co is the beneficial owner of this interest. How would the withholding tax implications in India go around it? Should we say that the US Co is receiving the interest and therefore we should look at the India-US tax treaty? Or should we say that India-Netherlands treaty is not applicable and 40% tax rate is applicable in this case?
Yeah, let's wait for answers.
This is a tricky one that way, but happy to know views.
If you would like to unmute yourself, that also is fine to share the response. No need of trying to type everything.
Yeah. Shall we move then? Pratik, you can answer maybe in the interest of time, because
please. Yes,
please.
Yeah. So again, there are both views possible, and there have been cases where one can argue that because US is the ultimate beneficial owner, so India-US treaty should be applicable. But at the same time, there is a very high risk that tax authorities may argue that the dividend interest received is in the hands of Netherlands company, and because of the inapplicability of India-Netherlands treaty, the entire interest can be taxed at 40%. Anything to add, Amit, on this?
Oh, so I would only say that from a tax department perspective, there have been litigations where tax department will try to say that once BV is not a beneficial owner, So then I will not go beyond and I will deny the treaty benefit and hence apply at the 40% rate. That is the position typically we have seen tax department being taking. And again, it boils down to the fact that how you demonstrate, because for all withholding and everything you have been using BV, it is only hindsight that things will come up. So it's always important to avoid such a situation. But given the fact that if such situation arise, then definitely you have a good argument or a defense to say that okay, if you as a tax department yourself is saying that US is the beneficial, BV is not the beneficial owner, and if I'm paying tax, then you at least apply the treaty in relation to the person who is the beneficial owner, and that argument can be taken. But again, these judgments are both favorable and against judgment on both sides. So it's again, it's not a very settled position, I would say. I think you can move ahead. Yeah. So this one perspective we wanted to give, and I think again linked to treaty, and when you is not it's linked to treaty, I would say, but not directly dependent on treaty. And as ICAI students, you might be knowing, it's good to know on those aspects. So typically, in case of interest, if you see, there are many categories of debt instruments where through which an Indian company can raise debt. So starting from the left, you have already heard of external commercial borrowings. And in case of external commercial borrowings, if they are foreign currency denominated, there is a specific provision under 194 LC, which gives you a beneficial rate of interest withholding on interest at 5% under the domestic law. However, this has a sunset clause up to July 2023. Now, in such situations, obviously, again, you have whenever this type of situations comes into before you, then you have to see that, okay, whether you test the domestic law, you test the treaty, and then you apply whichever is beneficial. As I mentioned earlier, mostly in DTAA, the interest rate is varying from 7.5 to 15%. So in such situations where there is an external commercial borrowing, foreign currency, or rupee denominated bond. The term used there in 194 LC is bond and not a loan. So obviously, if it is a bond instrument, then you can take a beneficial rate of 5% in case of ECB. The second category of debt instrument is debenture, and debentures may have further various categories. So one is the non-convertible debentures. There where again there is a beneficial rate applicable for only FIs and QFIs. And typically in off late, we have seen a lot of cases where FPIs, foreign portfolio investors, who are registered with SEBI, has invested money into India through this route to take a beneficial rate of interest. So again, in this case, it is 5%, but again, there is a sunset clause of July 2020, June is almost before 1st July 2023. In all other cases, it has to be either a treaty applicable rate, and wherever treaty is not applicable under DTAL, it is 40%. So this is the second category. And the third category is the category of government loan from government authorities or loan secured by the government authorities. There where again, in such cases, it could range depending upon the applicable treaty from 0 to 15%. In certain cases, as we mentioned earlier, you can also get a beneficial rate of 0%, as in the case of Netherlands, India. So you can go ahead, Pratik.
Yeah. So just a key takeaway from this slide, I just to reiterate. So as the rate of interest or a tax rate on interest is 7.5% to 15% in most of the treaties, there are cases in India where some of the instruments are taxed even at a lesser percent of 7.5%. So while analyzing the implications of interest income, one has to take into consideration whether there is a lower tax rate applicable in India or a higher tax rate applicable in India. In case there is a lower tax rate applicable in India, we do not need to get into the interest treaty application at all. That's just the key takeaway from this slide.
Yes.
Yeah. So this is a really nice and explanatory slide. Just one point also on this. I can see in a chat window there is a question. Can you please take up also, Pratik?
Yeah, actually, I'm not able to see the chat box because my screen is presented. So.
Yeah, even I missed. So Govind, if you can read out the question, we can answer. I also
Sure.
missed that question. Yeah.
So it's mentioned that can you please share some guidelines or case studies and write-ups explaining the beneficial owner and how the companies are dealing with this concept when they're structuring their business internationally. I think this we have already covered in the first
Earlier slide.
session. Yeah. So just want to confirm with Avijit, do you have any specific question here?
No, I just wanted, for the post-session study, just for understanding the concept of beneficial owner, if after the session you can share, some other, materials.
Okay. We will see and share something, Avijit.
Thank you. Thanks, Amit.
Okay.
Yeah.
Sure. The next case study was around the interest on income tax refund. So let's say there's an FCO which is situated in Italy and it has a P in India, and that company has paid income taxes in India on that P income, and somehow the taxes deposited were in excess of the tax liability in India, and now the Italy company is receiving a refund, and along with the refund there is an additional interest income because of the 244A. So just a quick question, whether what would be the withholding tax implications on receipt of interest on such refund? I've also tried pasting the relevant extracts of the India Italy DTAA for references, and just a quick answer on whether there would be any withholding tax implications on receipt of interest.
If I may attempt an answer here, going from the previous things, because this is paid out by the government, should that
exactly. So
then influence the
so the clause which we wanted to highlight here is, which I have highlighted in the box as well. So notwithstanding the para 2, so 15% is not applicable, and the interest will be exempt if the payer of the interest is the government of that contracting state. Yeah. So any interest or on from the government authorities would be exempt, specifically in India, Italy, and we are also evaluating whether we would be able to use this clause as MFN in the other relevant treaties applicable.
So this is where I think the point and the reflection everybody should have is that, again, how there are finer points, finer aspects which one needs to be very mindful of when reading the treaty, along with treaty number 1 and number 2, how it marries with the domestic tax laws to come with the best answer, or maybe the most optimum return. So if you see that, if we do fine reading of the treaty along with the reading of the MFN clauses and the DTA, you may get a very favorable answer, and you are able to very legitimately save on the taxes, which sometimes we are not aware, and we simply apply the treaty rate or a domestic rate. Go ahead, Pratik. So the next article is the capital gains, and I think this is one of the important article, but I would say relatively simpler in the case of share, relatively simpler in the sense that there are nuances only in relation to specific treaties, but generally in India, most of the treaties, India get the taxing right, except for the few treaties like Mauritius, Singapore in the past, and Netherlands, which is continue to enjoys rights to tax the capital gains vis-a-vis India in certain situations. There are a few other treaties like Sweden and others which give some favorable treatment on a limited basis. Sweden and France also have some favorable clauses, but on a very limited basis, where it gives benefit only up to say 10% of the capital gain in shareholding, etc. So Pratik, you can move ahead to the next slide. So in capital gains, I think first we are trying to cover the definition under DTL, which is domestic law which says any profit and gains arising on the transfer of a capital asset, and capital asset is a broadly defined uh, and to include shares, debentures, and securities. Typically, in the treaty situation, most of the cases you will come across are the cases where mostly shares are getting transferred. There could be few instances of immovable property or any entity which is driving a substantial value from immovable property can be there, but mostly it is more shares you will come across. Uh, in under the domestic law, which we one other thing we have to just keep in mind that for in case of a non-resident, any transfer of securities, shares, debentures, etc., is taxable at 10% in the hands of the non-resident if it is long term, and 40% in the case of short term. So again, vis-a-vis the Indian resident, there is a beneficial rate given to the non-residents in case of capital gains, which has come a few years back, where the government amended to promote more investment into the country. Go ahead, Pratik.
Yeah. So just to set the context right here, so India Netherlands uh, treaty in the capital gains article has 4 or 5 clauses, including the equity shares and the securities. So apart from equity shares and securities, there are 2 or 3 more articles which relates to the immovable property or the business assets transfer. And typically the concept is that wherever the specified property is situated, be it the immovable property or be it the uh, business connection or the PE business, that is the typical state which gets the right to tax that. Okay. For the purpose of this discussion, we have mainly focused on the transfer of shares and the securities because that is where the key controversies or the discussion points arises.
Yeah. So in case of capital gains as well, mostly in most of the treaties, you will find that both the states will have the taxing rights. In most of the cases, European and say countries like Singapore, Mauritius, there is no capital gains generally. Either you get some exemption in the domestic law or a participation exemption, some way or the other. Most of these countries will get an exemption. So in the India, in the situation of a European country or a Singapore or Mauritius versus India, you generally find that India will only tax it. In most of the cases, subject to certain conditions, you will get exemption in these countries. So that's why it is more important to see from the India perspective. We try to summarize some of the most commonly used treaties with India, which is Singapore, Mauritius, Netherlands. And in Singapore and Mauritius, and some of you may already know this, that this treaty underwent change in April 2017. So, and where and this change, they also brought the grandfathering provisions, where to say that any transfer of shares by Singapore or Mauritius of Indian company before which are acquired before April 17 is continue to be taxed in the hands of Singapore and not in India. So there's a grandfather provision. Then they talked about that any acquisitions after April 17 would be taxable in both the states, both the countries. So India also get the taxing right. So any investment by Singapore or Mauritius post 17 will be taxable in India as well. Uh, and the third situation was a very limited period window, which is a transitory window given to everybody. Is any shares acquired post 17 and transferred before 19 will be subject to tax at 50% of the applicable rate. So this is what the Singapore Mauritius talked about. Netherlands typically we have oversimplified the clause to say, but in Netherlands the sum and summary is that if Netherlands entity is holding at least 10% shares in the Indian company and transfers the shares of the Indian company to a non-resident, then the taxing rights lie with the Netherlands and not in India. And of late, we are seeing that more and more people are also routing their investment through Netherlands into India just to avail the benefit under this clause. But the key element continues. This clause also have the similar provisions of beneficial owner as well as the residential. And the third aspect which has also come into play is the MLI. So now you have to also do a under the MLI principal purpose test to determine whether what is the purpose of Netherlands being there as an entity. So this is a third test you have to do along with the treaty to ensure that you get a favorable answer of applying the treaty, and hence get an exemption or maybe exemption of the capital gain tax from an India perspective. Yeah, I think somebody was raising a question. No? Okay. And the other aspect in case of capital gains you have to see. So this provisions which I have talked about is almost common in case of shares, whether it is equity shares, preference shares. So as I mentioned, both the states generally have the taxing rights, except for the few instances which we have pointed out: Singapore, Mauritius, Netherlands, and these are the three key ones. Uh, there is a different outcome in case of securities. So say, for example, instead of shares, the investment is made by securities, say for example, debentures or compulsorily convertible debentures, optionally convertible debentures. So this could give a favorable outcome from an India perspective, where in for securities other than shares, again, in most of the treaties we are seeing is the holder of the share securities gets the right to tax. So in such cases, one can also structure the investment into India or plan the investment into India in a manner to do through other securities. And if you transfer those securities, then you may possibly get an answer where this right to tax these securities is with the Netherlands or Singapore or Mauritius, and such countries under domestic law do not tax it or have certain exemptions to it. Okay. Yeah. Pratik.
So, uh, just a quick case study on this. So what we have considered in this is there's a Netherlands company holding CCPS in the Indian company, and that Netherlands company is transferring those CCPS to another Singapore group company. So on transfer of these CCPS to the Singapore company, would there be any capital gain implications either in India or Netherlands? And I've also tried putting in the relevant clause of treaty.
I think
Yeah.
if we need like someone from participant to answer.
Yeah.
Yeah.
So, yeah,
Yeah,
case
we
study.
encourage that. Yeah.
Anybody, or we can give 30
Yeah,
seconds, or then Pratik can answer.
sure. Yeah, we also recommend that please unmute yourself so that we have a more participative discussion.
I would, Abhijit here again, I would think it would be taxed in Netherlands.
Yes. So Abhijit, just are you applying clause 4 or clause 5 here?
Well, actually, I was going by the logic that was, in the previous slide that was explained. Yes. Not really,
Okay.
these clauses yet, but yeah.
So just to clarify, so because CCPS is a share, this will be classified under clause 4, which will be alienation of shares forming substantial interest in the capital stock. And any such transfer by the Netherlands company of shares of the Indian company should not be taxable in India, right? And let me just tweak this a little bit and say what happens if we are selling this CCDs rather than a CCPS, because nowadays a lot of investors are infusing funds through CCD route. So what happens if Netherlands company is transferring CCDs instead of CCPS to the Singapore co? Would your answer still remain same, Abhijit?
It would be then the India, wherever the wherever that person is resident.
If the person
Right,
is
so
resident in Netherlands that way,
yes, so
because
let
he's
me
a
just
resident.
Yeah.
so
So,
at least the part where you need to focus on clause number 5 instead of clause number 4 in case of CCTs is correct. And when we read clause 5, the interpretation is that the tax implications will arise where the transferor or the alienator is resident, right? So in this case, since the
Netherlands.
Netherlands company is transferring, and so Netherlands, the tax implications will arise only in Netherlands.
Netherlands. Okay. Yeah. Understood.
Okay.
Thanks.
Just a more tweak. I am enjoying this, so bear with me. Sorry. What happens in case you are transferring units of business trust, say REIT or InvIT? Whether this would fall in any of the clause 4 or 5, and if yes, under which clause?
If it's REITs or any other thing, then it would be any other property as defined under clause 5.
Perfect. So that's exactly what we needed to discuss. That and this is one of the um, big discussion points happening with the investors these days. That if it's a units of a business trust, whether we will be eligible for a treaty exemption and under the India-Netherlands treaty, right?
Yeah.
And this has also led to new structures being formed to interpret the treaty and get a favorable outcome from the treaty. So there have been instances where now no more plain vanilla shares or preference shares people would like to do beyond a certain point, which is the minimum, maybe to just to match the debt equity ratio. But beyond that, different instruments, different vehicles have been set up to get a favorable outcome of the treaty. Yeah. Okay.
I think Amit has shared some bit of PwC advice here.
Yeah.
Okay.
Yeah.
So shall we move forward?
Yeah.
So another case study which is very specific to indirect transfer. So let me just brief you about the indirect transfer first. So in India, we do have a concept of indirect transfer where if we are selling shares of a foreign company which is deriving its value uh, substantially from the Indian company, so on such transfer of the intermediate company also there can be tax implications in India. Okay. In this example, let's hypothetically assume that MCO2, which is Mauritius Company 2, is also deriving its 100% value from the Indian company shares, and MCO1 is transferring shares of the MCO2. Now, the question is, when MCO1 will transfer shares of MCO2, would there be any indirect transfer implications in India? And if yes, whether MCO1 would be eligible to claim a treaty benefit?
MCO1 will be eligible or MCO2 will be eligible that way? Or which treaty will be applied that way? Yeah.
Any guess from the participants? Like it could be any guess based on the logic which we had understood now as of now, because I believe like Pratik and Amit was trying to bring up to the speed that we can apply the knowledge we have learned also, right? Because it's a little bit technical subject and a lot of scenarios are applicable. It always better to have a quick reactions. Anyone from the team?
I'll also have a, so just to give you the first answer, which is pretty obvious here, that yes, on transfer of MCO2, the indirect transfer implications would be applicable, right? So there would be a tax implications in India, even if MCO1 is transferring shares of another MCO2. The main point is whether on such transfer, the gains which are taxable in India, whether the MCO1 would be eligible to claim some benefit, or whether the same would have to be taxed in India. And for this, we have also pasted the relevant clauses of the India-Mauritius double tax treaty. And I just urge you guys to have a look once and see whether we would be whether there would be any tax implications in India while reading this clause.
I am following the chat box and I can unmute if you're not able to.
So do we have any replies on the chat box?
No, Pratik.
Okay, so
Not yet.
Abhijit, my buddy here on the chat, just please unmute. I think
He's on the spot then.
yeah,
He's on the
just I think you're going to be my buddy for this case studies. I'm so sorry to bring you on the limelight. So what do you think about this?
Okay, so basically, since it is acquired after, if the clause says gains, from the alienation of shares acquired on or after 1st of April, right? But MCO 1 is acquired, MCO 2 post 31st March. So
let's say they acquired it in March 15. So it's a 2015 it's a 2019 transaction per se. Let's say the treaty provision, it's a detrimental and it is taxable in India from that perspective.
So if it is, before 1st of April, then MCO 2 would not be sort of subject to tax, because then what it says is the contracting state will only be the in which the alienator is resident. That will be clause 4.
Okay. So I'll just elaborate or hear me out this. MCO 1 is transferring shares of MCO 2, right?
Mm-hmm.
Let's read it from that perspective whether clause 3A would be applicable. Gains from alienation of shares acquired after April 17. Let's say they acquired after 17, but in a company which is resident of a contracting state. So when MCO 1 is transferring shares of MCO 2, MCO 1 is not transferring shares of an Indian company. So per se, your clause 3A would not be applicable because gains from alienation of shares in a company which is resident of a contracting state. So while you are transferring shares of MCO 2, the treaty is not applicable. So because this will not fall in clause 3A, we will go back to the residual clause, which is gains from alienation of any property other than 1 to 3 and 3A. And there the tax is applicable only in the country where the alienator is resident.
So I think the key takeaway we have to see is that when we read the treaty again, so it's not about assuming that everything is taxable and everything is after 2017 and which is taxable. What we have to see again the final reading of the treaty to say that okay, where MCO 2 is situated and the language of 3A is saying it should be a resident of the contracting state, may be taxed in that state. So MCO 2 is not a resident of India.
India.
And hence, if it is not a resident of India, then 3A applicability on the plain reading, as the law states, will not be there. And there where you have to look for another clause where one can rely on this. So in case of indirect transfer cases in certain treaties, you may get a beneficial outcome, say for example in Mauritius. But there are certain treaties like US, UK, which do not give you this type of benefit, and it says that you can be taxed in either of the states. And there where you have a different outcome. So again, reading the treaty very minutely and see in which subclause you are getting fit is very important. So the approach you have to always follow is that go by each clause, keep on eliminating it till you find the right clause where you get fit in. Pratik, do you also have that language of US, UK in this presentation, or maybe no?
No, Amit. I think, but US and UK simply says that it will be taxed in both the countries as per their domestic laws.
Okay, so the language uses in both the countries as per the domestic law. So then both the countries, then India gets a right to tax in case of indirect tax. It is not very prescriptive in language in US, UK, unlike Mauritius, where it has used the word that it should be resident of the contracting state, this entity, M2. Am I clear to everyone?
Yeah.
Yep.
Okay, let's move forward then.
Okay.
Now, moving on to the royalty and fee for technical service. So I think I would say relatively the first three clauses or articles are much, while there are a lot of nuances and one can plan around it and from a corporate action perspective, they are most actively used. Royalty and fee for technical service, I would say, is more subject to interpretation, and more there are a lot of disputes around various areas of interpretation, treaty, and to that extent, maybe I would say a bit more intricate and complex than the first three clauses which we have talked about. We can move forward, Pratik. First, we'll talk about the royalty, and this is just for reading, but I think the message which we are trying to give under from this slide is that under royalty, the Indian income tax has covered almost everything. So if you see that, it means to say that any transfer of all or any rights in relation to patents, innovation, model, design, secret formula, or process or trade, they have covered everything on that. Any transfer or any right relating to that. Any imparting of any information concerning any technical, industrial, commercial, or scientific knowledge. So they have again covered the imparting of knowledge as well as part of the royalty, and it could be in the nature of technical, industrial, commercial, scientific, whatever. Then they have also covered in royalty the use or right to use any industrial, commercial, or scientific equipment. So it's if I give you something to use, or give you a right to use of any industrial, commercial, or scientific equipment, that is also covered. And fourth aspect, what they have covered is the transfer of all or any rights in respect of copyright, literary, artistic, scientific work. So it is a very wide definition which they have covered, and they have tried to cover everything under the sun. Once we go to the treaty definition in the next slide, it is more
Amit,
restrictive than
question.
this. Yeah, Vijay.
Amit, I want to ask you. So let's say, for example, we've seen all these foreign hotel hospitality, companies coming up, opening up franchises in India, right? So let's say Hilton comes and opens up a franchisee, and there is an Indian company that is building this hotel. So would that sort of brand be also considered, or any payments made for that be also considered as royalty?
No, so again we have to, and maybe I will answer that once we understand both the definitions, and we'll see that how to go about it. But the point you have to see is that whether you are falling in any one of the categories, whether it is a transfer of any right, so franchise. So in your example, you will typically get a right to operate that hotel, and you will get a right to use their brand. Okay.
Yeah.
So these two things typically happen where you get a brand, right? You pay a brand royalty for using their brand, and then you also typically get their processes, systems, their approach, their best practices to follow, for which they also try to charge you a fees linked to your top line or whatever way. So again, in that cases, if you see, one, you are forming under the brand, which is right to use, which comes under some sort of a right, and then you are also getting into the process, which is the first one, because you also get a process to know.
Yeah.
So there could be a situation, and depending on, there were various ways to structure it, but initial response is that you may still fall under the royalty. But let us understand the definition of royalty as well under DTA, and there where we have to play between the Indian definition and the DTA definition to see that whether though I am falling under the definition of India and the domestic law, whether I can get out of the definition from the DTA perspective, and hence we may have a favorable answer, even if the Indian authorities classify this as a royalty income. So now coming back to the definition of DTA, there where the definition is more limited, and there where, if you see, and as we move forward, Pratik has a lot of case studies to discuss, where you will find that by using the definition of DTA, the SSEs have come out of the purview of the Indian domestic law, and hence classified something as not a royalty which is subject to a withholding in India. So if you see, so what DTA says, payment of any kind received as a consideration for use or right to use. So I think this is a very important word, and we have emphasized either there has to be something, the payment you have got for something is using something or a right to use something, and that something is copyright of literary, artistic, or scientific work. That is copyright, or that is one category. Second category is the you are getting something, a secret formula or a process. So if you are paying something for a secret formula, some formula you have got which nobody else has access, and by using that formula you are able to create some value, then obviously that is in the nature of royalty and you have to pay. Or you have got a secret process. Again, the word secret has been used with the process as well based on various judicial precedent. You got a secret process to do something which nobody knows. So in the franchisee example, say for example you have taken, I will build on that. Say if that those are best practices which are common to everybody and it is known to everybody, then possibly somebody may say that it's not a secret process I am getting, it's just the best practices and anybody can have access to it, or it is more logical in nature. So then you may try to say that okay, I will not pay for that, but I'm only paying for the brand I'm using. And the third angle is the use or right to use the industrial, commercial, or scientific equipments. And again, it is more relevant in the case of judgments relating to satellites and other cases which will take up as we move forward. And one of the leading judgments in that regard was Asia Sat, etc. So that is one category: use or right to use, copyrights, secret formula process, or equipments. The second category is the information concerning industrial, commercial, or scientific experience. So again, if I am sharing any information concerning industrial, commercial, or scientific experience, then you may also be classified as a royalty subject to a withholding tax in India. And again, this you may say is a quite broad. It is information sharing and experience which could be valuable to you. Move ahead, Pratik. And as we move forward, we'll build around. So here we have tried to classify and this to explain you guys in much greater detail that these are three categories of royalty which we'll typically talk about in the basis the definition we have talked about in the earlier slide. So one is in the relation to copyright. Now, copyright typically you may have copyrights in relation to software, you may have copyright relating to music, albums, books, artistic work, etc. So this is one category. Typically, you'll find most of the litigations or most subject to interpretation.
Amit, hi.
Yeah,
If we can, I can take it this up now.
yeah. Please go ahead.
So guys, there are, as we discussed in the previous slide, there are majorly three types of royalty incomes. One is the copyright royalty, the other one is the process royalty, and the third one is use of the equipments one, right? So talking about the copyright royalty, what one needs to see is whether use of an article constitutes the use of the copyright or constitutes use of the copyrighted article, right? So that's the fine difference which we are looking at. And the second point which we need to look at is uh, the tax or the royalty is considered when you are using the right or use of right to use any copyright of literary work. So what constitutes literary work? So artistic and scientific work is still something which is easy to interpret, but what exactly is the literary work? And for that we go back to the Copyright Act and see that the literary work also includes the computer softwares or computer programs. So one key takeaway from the left hand side is that any use of software is also a use of the literary work. Now, whether use of that software would constitute a use of copyright is something which we'll discuss in the ensuing slides. The second
But
one is the
no,
process royalty.
just hold on, Pratik. Just hold on. So no, I think maybe let us give some example to everybody get a context. So when Pratik mentioned about copyright versus copyrighted article, let us understand by a simple example. You buy a book, so then it is like a copyrighted article where somebody has written the book. Bought that book and you can read that book, you can pass on that book. That's all you can do about it. But the other situation is that you get a copyright of that book, which means to say that okay, I as an author has given you a copyright, and then if you have that right of copyright right, then you can amend, do modification to that book, or use that book content in a manner you would like to do for your whatever purposes you think of. So what is important, this principle you have to keep in mind is that whenever you are testing it, whether it is relating to software, whether it is relating to artistic work, whether it is relating to music album or anything else which forms as a a royalty, what you have to see is what you are getting. You are just getting a right to consume that, or you are getting a right to modify, replicate, or use that content in a manner you want. So just a right to use, or just or consume, or you can do something beyond that. And if you can do something beyond that, the right to consume, then you are getting a copyright on which a royalty is payable. Am I clear to everyone?
Yes, yes.
Okay. So Pratik, move ahead, process.
Yeah. The second category is using the process royalty, which is basically any kind of a right of imparting any knowledge or any kind of an information on how to run a process, right? So any kind of an industrial benefit or a hotel management business which involves some kind of a designated processes is something which is considered as a process royalty. And to be, it's not defined under the Income Tax Act, but on a general parlance, process is defined as a series of actions or the steps taken in order to achieve a particular end. The main point here to distinguish between the process from an Income Tax Act and from a treaty perspective is that the process needs to be secret. So I'll just go back one slide. The language of the treaty says use or right to use any patent, trademark, anything in secret formula or process. And there are loads of judicial precedents around the matter, whether this process needs to be read along with the secret formula or is it an independent process. And we have a lot of judicial precedents which says that this process has to be read along with secret formula, and therefore the process also has to be a secret process to be considered as a royalty income. Right. So
And this is where, just to add, this is what Pratik was saying, that this secret term has been an important term, and if you distinguish the law in India under the domestic law versus treaty, treaty is putting an emphasis on secret, and Indian law has been changed to say that it doesn't matter whether it is secret or not secret, still any process I will classify as a royalty. And this is a big debate. So whenever you are reading a treaty along with the domestic law, you have to see that domestic law says I do not care whether this is a secret process or non-secret. I will, if it is a process, I will, it will fall under the royalty definition. But then you have to rely on the treaty to drive that language of the term secret to say that, okay, if it is a secret process, then only it should classify as royalty, and hence on which the applicable rate should apply. What, Pratik?
The third leg is the use or right to use of an equipment, which is equipment royalty. There also, again, we do not have any specified clarification on what exactly constitutes a royalty in this regard, but there are lots of judicial precedents which defines the principles that in case we have as a user or as a lessee of the equipment, if we have a significant control over the asset, or there is an exclusive use over the asset, or it's in the possession of the lessee, and there is no risk associated with any kind of non-performance, that in case this does not happen, I would have to return this or something of that sort, then we can specifically say that the equipment is in the control and possession of the lessee, and therefore any payment for use of such scientific equipment will also be considered as under the definition of the royalty.
So just to maybe so that you guys relate. So say for example, and we put it a more real-time example is that one, you get a equipment or a plant and machinery which is at your disposal, at your control. You can use it for the relevant purpose you are doing. It is for exclusive use. You have all the possession, and whether it performs not performs, it is up to the user. So then it can classify as a equipment royalty. The other term could be, say, for example, I hire a cab along with a chauffeur from a service provider, and then from going from A to B. Now it is being driven by the chauffeur. He has to decide which way he has to go. I have no control on his things, and but he has to only make me reach the destination. So then nobody can say that I've hired that car or for the use, and it should not classify as a equipment royalty. It is just a service I have got it. I have no control on it. I have no exclusive use and no possession on that car for that time being as well. So typically, one has to distinguish. These 4 or 5 tests have come from the judicial precedents and generally upheld by the court of law, not coming from the definition of treaty or income tax. Go ahead, Pratik, please.
Yeah. And just
Amit,
to,
I have,
Yeah.
Pratik,
Yeah.
yeah,
I have a
sure.
question. Yeah. Just building on your example of the Uber cab, right? Now Uber, uses this particular application, right? So does this mean that if, for example, Uber India is paying some sum of money or amount of money to the headquarters for the use of the application, not so much, proceeds of the car ride and all of that, wouldn't that qualify as royalty?
No, so in this case, typically what will happen is that Uber has developed a platform which will enable Uber India to conduct that business in a particular way. The entire ecosystem, the mapping, the car tracking, how the leads are generated. So for that, because that is a secret process they have developed and which is not accessible to others, then that could be classified as a royalty on which Uber India has to pay a charge,
Yeah.
royalty payment.
Okay. All right. Thank you.
Yeah.
So just one more thing, as Amit was also saying, in 2012, there was a retrospective amendment in relation to what constitutes royalty under the domestic law. And with reference to your first uh, software, it was retrospectively clarified that any use of software will be considered as a royalty. And with reference to the process royalty, they had very specifically covered satellites right now, that any satellite process, whether it's a secret process or not, will be considered as royalty. And for equipment also, they brought a very clear-cut explanation that any kind of use of equipment, whether or not it is under your control or possession, would still be considered as a equipment royalty under the Indian domestic laws.
Yeah, Pratik, move ahead. I think we have to be conscious on time as well.
Yeah.
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 Okay. Go ahead.
Okay. So just to brief you guys, so this is typically the case study which we were discussing previously also, that let's say a Netherlands company has transferred a software to the ICO, but ICO does not have any right to modify or reverse engineer or decompile any of the software elements. So in this kind of situation, under the Indian domestic law, this would still be considered as a royalty because it is use of the software by the BV to go to ICO. But under the DTAA, because such kind of rights which given to the ICO do not constitute a copyright, and therefore one can still take a position under DTAA that it should not be considered as a royalty income.
So say take an example of Microsoft Office. So Microsoft Office, if you get from outside, Microsoft loads onto your computer, then and you pay a fees for that. Maybe under in domestic law, it may classify as a royalty because the wide wording of that. But under DTA, you may still be out of it because you only got a copyrighted article to consume, but you do not get the copyright of Microsoft Office to do whatever you want to do with Microsoft Office or modify the source code or change the entire format, etc. You didn't do anything. You can't do anything. So under DTAA, you will not. This will not get taxed as a royalty. But if the DTAA is not applicable, the domestic law will tax it as a royalty income because you are getting a copy. You are getting a software and the way they have amended the language to include everything.
Yeah. Similar to the concepts previously explained and reiteration of the examples which Amit quoted, like purchasing a copyright for a song will constitute a royalty, while purchasing of an audio CD will not be considered as a royalty. Similarly, purchasing a copyright on any book for further publishing or doing some amendments is a royalty, but purchasing a novel will not constitute a royalty. Or 4 or 5 years back, we used to purchase CDs for downloading a software on our PCs or laptops. Those kind of purchase of CDs also is nothing but use of the copyrighted article rather than use of the copyright, and hence should not be considered as a royalty income under the double tax agreements.
Okay.
Moving on, there was another very interesting case where uh, the tax authorities had argued that while we are purchasing phone, there's a Android or OS integrated along with the hardware. So whether purchase of that software which is integrated in the hardware should be considered as a royalty income, and we have favorable judicial precedents around it that which says that this kind of a software, it only facilitates the use of the hardware which forms part of the uh, major purchase for the consumer, and accordingly this should not be considered as royalty income.
So there have been instances you guys where say Apple or Samsung of the world for certain accounting other reasons was showing software components separately, and they led to a lot of disputes. But the point was that this software is nothing which is enabling the hardware to work. I, as a consumer, is not getting a software as a separate service or something which I can mm, be independent value to me, or I can modify or use do something about it. So, hence now of late there have been a lot of positive jurisprudence on this to say that okay, if it is a part of the hardware and it is enabling that hardware, then it should be treated as a sale of product or part of the hardware and not as a separate sale of software. Okay, go ahead, please.
Okay, so this is also a very typical case, and I'll just spend 1 minute on this. So this was the case which brought the amendments in 2012 regarding the process and the equipment. Here, what would happen is that uh, there is a uploader of the signal, which is, let's say, sitting in US, Netflix hypothetically, sitting in US, which is uploading signals on a satellite, which is in the outer space, and there are transponders in India which receives those signals in India, and there were a lot of litigations around whether the payments made by the transponders or the consumers in India should be taxed in India. In this reference, there were 2 points which were very crucial. One, the tax authorities said that it's the process, and the Indian transponders are basically paying for those kind of processes, and therefore should be taxable in India, which got counter argued because this kind of process, which is downloading signals from a satellite, is not a secret process, and hence all the controversy around the secret formula and secret process came around. There was a favorable process that yes, the process
So
needs to be read
just
along with
Pratik, just
secret.
yeah, just okay, you are on the secret only. Go ahead, please, Pratik. Yeah, I thought you missed that one. Okay, go ahead, please.
No. So there are favorable precedents that yes, the secret word needs to be read along with the process, and in such kind of situations where the process is known to all of everyone, does not constitute a process royalty per se from a DTAA perspective, and hence should not be taxable. Yes, Amit, you were adding something.
No, so I was just adding. I think this the point which we have to see is the process and the use of equipment. So the both
Yes.
things what take up in this this matter, and what you have to again it will help you relate is again the question was come that whether this process is secret or open, and it was explained that anybody knows the process how the things are uplinked and downlinked. So there's nothing secret about this process. Everybody knows. You can go and Google it and you will find it how a satellite functions and how it is uploaded and downloaded. So then the argument says that okay, if it is it's not a secret process, and the Indian government retrospectively amended the law to say that I don't care whether it is secret or not. So that was the genesis of why secret was removed. And the second is whether it is a use of equipment or not. And again, it was the case that this I as a consumer is only paying a fees to get this service. I am not have any sort of a control possession of that equipment which is delivering that service to me. And this was the example I also gave from the user Uber perspective. I am only a consumer of the service. I have no control on that equipment which is rendering me that service. So hence, in both the arguments were favorably seen under treaty, and there was said no royalty payment is there. So this is these aspects you should keep in remembering. The reason we are raising these case studies is just to for you guys to relate that how you distinguish a particular case from a royalty, or whether it is royalty or something else. And what it's something else we'll cover separately, whether it is, if it is not royalty, whether it becomes a business income or income from other sources. That is the next question which may follow. But the idea is first we are out of the royalty income, and then we'll have to determine what it is, what is the nature. Go ahead, Pratik.
Yeah. I think that's the overall gist of it, and we can come to FTS now.
Okay, so just maybe as a concluding point on royalty. So what we are saying is that it is use or right to use on three things: copyright, process, and equipment. This you have to remember. Second, you have to distinguish between the domestic law and the treaty reading. Domestic law is very wide, treaty restricts it, and you have to interpret that way. And the third thing is, if it is not a royalty income, then more logical and favorable view is because it is linked to the business, and it is for the business, and it is in the nature of the business. It should classify as a business income. And if it is a business income and the non-resident do not have a permanent establishment in India, then no tax incidence will arise in India, and hence there is no withholding. So this is typically the entire roadmap or journey is where you have to rely and apply to see that, okay, it's no royalty, and then if it is a business income, then there should be no tax in India. While tax authorities in many cases have tried to argue that, okay, if it is not royalty, but it is income from other sources, but then in the court of law, it has been upheld in many cases that it should classify as a business income if not royalty. And in many cases, people have the companies in India have not withheld tax on that basis. I think let's move ahead. But how much time we have? Just maybe I think it's just 6 minutes, but can we overshoot by 7 minutes, Govind? Or what is the
probably like if you have more content to cover, but if you can summarize the things and we can try to capture some questions if there is any.
Okay. So just try to quickly summarize. So again, on fee for technical services, we have tried to side by side put the definition under Act and the DTA. The principle and the way we have to read FTS, fee for technical services, is in the same sequence, threefold. Fee for technical services consideration means that any consideration paid for rendering managerial, technical, or consultancy services. Managerial, as we see, is like any executive of the company rendering managerial services. That is, we can commonly understand. Technical services could be any technical in nature, architect, engineering services, etc. And consultancy services could be something like what PwC is rendering or a consulting firm is rendering. In certain cases, there could be overlap as well. It could be technical come consultancy. So these are the three buckets which we'll deliberate and debate as we move forward: managerial, technical, and consultancy services, what it means and what is the interplay. That is under the domestic law. Under DTA, just go back one point. Yeah. Under DTA, what we have to see is beyond this definition of managerial, technical, and consultancy services, there are certain treaties which also talks about the concept of make available that technical knowledge, experience, or know-how. So it is using the term make available. So it is like an exception or exclusion or a more restrictive definition in certain treaties where they are saying, okay, if you are rendering managerial, technical, and consultancy services, and if there is no make available, then obviously no tax incidence should arise. But if it is a make available thing, which it means that you are making available a particular know-how or a technology to the other person for him to use independent of you in his own way. So then you are making available or enabling that person to stand on his own feet. Then only I will treat this fee for technical services as something which is taxable in the source country. So this is where the restrictive definition is there in certain treaties, and we'll see how we move forward. Go ahead, Pratik. In this slide, we have quickly wanted to summarize and give you a big perspective is that what are the various categories of treaties and what are the various which has different categories of definitions of FTS. So on the left side, there is a comprehensive definition without any restrictions to say that any managerial, technical or commercial services will be covered under FTS, and such treaties are like Ireland, Lithuania, etc. Then there are treaties with restrictive definitions which have the make available clause that you provide managerial, technical and consultancy services. But if you are only making available something, then only it will fall under the FTS, and these are like US, UK, Canada, Singapore. Then there are certain treaties which have actually not covered the managerial part of it. So they are only talking about technical and consultancy services, and you make available, which are like Netherlands, Canada, US, UK. And then certain treaties are there which are only covering FTS. There is no separate clause for FTS, and it is only covered under the royalty definition, which is like Australia. And there are certain treaties where the FTS clause is absent. So in such cases, you have to see, then you have to go by the domestic law, and the domestic law will come into play, and then obviously it can lead to a higher tax incidence, or maybe under no royalty, under domestic law, it is only 10% flat. So then you go by that. And then obviously there are countries which are there are treaties where you have to see that, okay, all this is there, and then certain treaties give you a more favorable answer, then you import the MFN clause, which is the most favored. And again, we have seen certain countries like Portugal, which gives you a MFN clause, which is beneficial for testing the treaty between, say, India, Switzerland, and Netherlands.
So
Sorry,
that's
Sweden,
the
Spain, and
practical
Netherlands.
insight that from Portugal's double tax agreement, we are importing the make available clause while interpreting Sweden, Spain, and Netherlands.
Yeah. So there where you may get a more favorable answer, maybe a lower withholding because Portugal has a 5% rate, I think, Pratik, if I'm not wrong.
No. So from a Portugal's perspective, we are importing the restrictive scope.
Okay, restrictive.
Right.
Okay.
So because of the Portugal treaty, we are able to import Netherlands as a restrictive definition. So we are able to take a position only if there is a make available of those services, only then it would be taxed under the treaty. Otherwise, it will not be taxed.
So two things on make available we will do. One is the restrictive scope, or the other is the treaty rate. So say, for example, by using make available, most favored nation clause, either we can reduce the rate, and the second what Pratik was mentioning in case of Portugal is that we are saying, okay, because Portugal has a make available clause, we'll say, okay, in Sweden, or we are testing Netherlands versus India, then you have to also applying the MFN, you have to say that the taxation right of India will arise only if Netherlands company is making available that particular managerial, commercial, or technical and consultancy services to India. If it is not making available, then obviously India will not get a taxing right by applying the MFN under the Portugal. Go ahead. I think so. This is a comprehensive picture you will get. Yeah.
I think this should be our last slide where the main concept of make available should be given. That's it.
You can complete this slide and then we can open for questions. Yeah.
Sure. So again, make available is not something which has any definition per se under the act or a treaty, but India-US treaty provides a detailed, comprehensive note around what exactly make available means. And in sum and summary, basically the make available means that the service recipient should acquire the relevant knowledge or the service and should have the relevant knowledge to apply it further for future use without the use of the initial service provider. So if A is providing services to B, in future B would not require services of A to either provide those services to some other person or for further consumption or utilization.
So say for example, maybe through an example you guys will understand better. Say for example, an architect will give you a design, and then design to you for your house, and then they will ask you, okay, you can make the house. So I get the design from an architect, uh, and then I construct the house on myself. So whether that architect has make available to us that knowledge, know-how, or that consultancy service, and you have to see from the three tests which Pratik has just explained. So Pratik, you can just go ahead and explain.
Yeah, so when we are availing the architect services, the architect is simply drawing out the charts for construction of the building, and we as consumers would not have the relevant know-how to modify or customize those designs, right? Or we as consumers would not be eligible to use those designs for some further uh, architect services. So therefore the architect is ensuring that we are not uh, getting the relevant know-how from the architect, and hence it will not qualify as a make available. The second example which we wanted to take was very relevant, a pilot training course. So there are a lot of service providers who train commercial pilots on how to fly an airplane. Such kind of services constitutes a make available, because going forward the commercial pilots would have the relevant knowledge to fly those airplanes independently without going back to the service providers for more training, and such kind of services then becomes a make available.
So this is a simpler examples of real life to for you guys to relate that what is make available. In architect, they have provided design, but you may not be competent, or you are not being enabled to do tweaking or modifying that design on your own till you consult them back, because you may do a error and then you may not have a robust structure. In the case of pilot, you are getting enabled to fly the aircraft on your own, and hence this is something make available to the person, and henceforth he can apply that knowledge to fly a plane. So I think Govind, while there are other case studies, but typically this is the way we will close our conversations as of now. In the end of the presentation, we can take Q&A, and if we can also share these slides for all the participants to consume them separately.
Yeah, no, thanks, Amit ji. I have not seen any new questions in the chat box. The one we have already covered in our participation and discussion with Avjit already. Avjit and other team members, do you have any new query on the topics we have covered just now?
Not immediately, but I'm looking forward to some more, reading material on the
Okay,
beneficial
great.
work.
And all other participants, you can unmute yourself. We have a dedicated time now. Like if you have any questions or doubt which part of this discussion or any other wild query also, which you would like to get it clarified from the experts here. Okay, while we are waiting, I just want to confirm, like Pratik, will you be sharing the slides with me?
Yes, he will share.
Yeah,
okay.
yeah, Govind, we'll share.
Okay. I think this session and the slides are very much interactive, especially the a graphical display you have added, the tree structure. It's very useful to understand the differences by country and the scenario. So I think that would help us to remember those articles very well also. I think we don't have any questions. So I would also like to conclude the session, and probably we will cover up in the next session. So let me start sharing my screen. I just want to confirm that we have already covered our first 4 sessions in like this. So now we have a plan to reconnect on 27th November. This is the last workshop, I would say, which is covering article number 14, 15, 16, 17, and 18. The speaker would be our past president, Valuecent. So we expect like we will have a similar engagement and concluding overall our international taxation concepts for our audience. And I'm really glad that we had a good such participation and good questions over a period of this long workshop. With this, I would like to thanks on behalf of Netherlands Managing Committee and Working Committee and all the participants to our speakers, Amit, Amit Agarwal and Pratik. It was a really interactive. I will definitely feel that all the audience has learned something new, especially me. I can really say, because in my all the engagement, we used to have a tax consultants to clarify this kind of technical legal arrangement. So it was really interesting for me also to get the other side of it. So I would say once again, a big thanks for your expertise and valuable insight shared here.
Yeah. So thanks, Govind, and thanks all the participants. All the best for your preparation, exams, etc. And I will be sharing this slide deck and happy to answer any specific queries any participant has after this, so they can write to me, Pratik, and we can answer that.
Okay. Great. Yeah, that's also a very good point. If anything new comes up, we will direct those questions to you.
Yes. Okay.
Yeah.
Okay.
Thank you everyone for
everyone.
giving us this opportunity as well. And hope we interact in future more.
Yeah, definitely. Thanks, Pratik.
Okay, bye.
Thank you. Happy weekend.
Bye. Yeah, same to you.
Bye-bye.
Bye.